Think about all the stuff you use every day. How do the raw materials for all of it actually get from point A to point B? A huge chunk of it travels on trains, in these specialized railcars owned by companies most of us have never even heard of. Well, today we're going to pull back the curtain on one of the most important ones, GATX. They're like this silent, invisible giant that keeps the industrial economy humming. And if you're looking at this from an investor's point of view, it's a fascinating story of incredible stability, but also some real risk, and a single move that changed everything.
All right, let's just jump right in with a pretty wild question. I want you to think about this for a second. What S&P 500 company has paid a dividend, a check to its shareholders, through every single recession for over 100 years? I'm talking the Great Depression, the dot-com bust, the 2008 financial crisis, the COVID pandemic. Through all of that chaos, one company never missed a payment. Any guesses? What kind of company could possibly have that level of resilience? The answer? It's GATX. And that streak of uninterrupted dividends started way, way back in 1919. Now, look, that's not just a cool piece of trivia. For an investor, that's like the ultimate signal. It screams that this is a durable, time-tested business that can handle pretty much any economic storm you can throw at it. So the real question is, how did they do it? How do you build a business that tough? Okay, let's start with the bull case. And really, the best way to think about it is that GATX has spent a century building a massive economic fortress. So let's take a look at the business model, the cash flow, and all the things that make those walls so high. So what's the secret sauce? Well, it's crucial to understand that GATX doesn't just, rent out a piece of metal on wheels. They do something called full-service leasing. That means if you're a big chemical company and you lease a tank car, GATX handles everything, all the maintenance, the complicated regulatory paperwork, even the taxes. It creates this really deep, sticky relationship. Customers aren't just getting a rail car, they're getting a whole problem solved for them, a totally hassle-free solution. And that model creates some serious financial power. Check this number out, $3.8 billion. That's how much GATX has in future lease payments already locked in, contractually committed, just for its North American fleet. From an investor's perspective, this is the holy grail. It's basically an annuity. You have incredible visibility into future revenue, which is something you almost never see in the industrial world. And that leads us to their competitive moat, which is just massive. I mean, think about it. Let's say you wanted to compete with GATX. First, you'd need billions of dollars, with a B, just to buy the rail cars. Okay, then what? You'd have to build a maintenance network that stretches across the entire continent. Then you'd somehow have to build the same customer relationships they've spent decades developing. Oh, and you'd also need an army of experts to deal with all the complex regulations. It's just a ridiculously hard business to break into, and that's what protects their profits. And the best part? These railcars can last 35, even 50 years, just generating cash flow decade after decade. And look, this fortress isn't just some theory. The numbers back it all up. In 2024, their fleet utilization was 99.1%. That means basically every single car they own is out there, on the rails, making money. And even better, when those leases expire, more than 85% of customers re-up. That shows you just how strong the demand is and how loyal their customers are. Okay. So that's a pretty powerful bull case, right? A fortress with a huge moat, predictable cash flows. But, no fortress is truly perfect. And every smart investor knows you have to ask the hard questions. So what are the weaknesses here? What happens when the economy inevitably slows down? So now, let's put on a different hat. Let's play the bear. If the bull case is about admiring the fortress, the bear case is all about looking for the cracks in the foundation. And we're going to focus on three big ones: debt, competition, and the business cycle itself. All right, the first potential crack is debt, or what investors call leverage. This is a super asset-heavy business, right? You need a ton of money to buy all those rail cars, and GATX uses a lot of debt to do it. And that debt-to-equity ratio has been creeping up pretty steadily for about a decade now. Now, sure, that debt is backed by good, stable assets, but it's still debt. And it makes the company way more sensitive to rising interest rates, which can really start to squeeze their profits. Next up, let's talk competition. This is really interesting. GATX is a pure play leaser. That's all they do. But their biggest competitors, guys like Trinity and Greenbrier, they do two things. They build new rail cars and they also lease them out. Now here's the risk for GATX. When the economy gets tough, these competitors might be willing to lose money on their leases just to keep their factories busy building new cars. They could use their manufacturing profits to subsidize their lease prices, undercutting GATX and starting a price war. But really, the entire bear case boils down to one simple fact.
At the end of the day, GATX is tied to the health of the industrial economy. They can have all the long-term contracts in the world, but they can't escape the business cycle. If factories slow down and freight volumes drop, demand for railcars drops right along with it. And that means two things: lower utilization rates and a whole lot of pressure on lease prices when it's time to renew.
Okay, so we've got the strong bull case, we've got the worrying bear case, and just when you think you've got the whole picture, GATX goes and does something massive. They made a transformative acquisition, buying the entire Wells Fargo rail portfolio. And this one deal, it's like a giant amplifier. It makes the bull case even stronger and the bear case even riskier.
I mean, just look at the scale of this thing. Before the deal, GATX was a big player, sure, with about 14% of the market. After the deal, they leaped to roughly 25% market share. They're now the undisputed dominant leader in North America, almost twice as big as their nearest competitor. From a bull perspective, this is huge. It seriously cranks up their pricing power and their network advantages.
But there's always a but, right? Here's the trade-off. This quote from a research report really nails it. This deal marks a fundamental shift in what kind of company GATX is. See, they were always known for their super stable fleet of tank cars, but the fleet they just bought, it's full of more cyclical freight cars. So yeah, they bought market dominance, but they paid for it by taking on a lot more exposure to the more volatile boom and bust parts of the economy.
So where does that leave us? As an investor, what do you do with all this? The bull case just got stronger, but the bear case just got scarier. So let's try to pull this all together and figure out what are the key things you need to watch. It really all comes down to this one central tension. The bulls are looking at this and seeing a company that cemented its #1 spot and is about to become an even more powerful cash flow machine. The bears, on the other hand, see a company that took on a ton of debt to double down on the riskiest part of the market, maybe at the worst possible time. And you know what? They're both right. The whole investment thesis really boils down to which of these forces wins out in the end. So if you're going to follow this story, here's your personal investor dashboard. These are the numbers to watch. First, GATX's own numbers, fleet utilization, and their lease price index. That tells you if demand and their pricing power are staying strong. Then look at the big picture stuff, weekly rail traffic data and manufacturing reports. Those are your early warning signs of an economic slowdown. And finally, you absolutely have to watch benchmark interest rates because that hits their borrowing costs directly. Put them all together, and these metrics will tell you the real story. And that really brings us to the one big question you, as an investor, have to answer for yourself. Did GATX just use this massive deal to build an even bigger, more powerful fortress that's truly built for the long haul? Or did they just take on way too much risk, essentially adding a shaky new wing to the castle right as a big storm is gathering on the horizon? The answer to that question is going to decide everything for this invisible engine of the economy.